Hey everybody, thanks for attending today. We're just getting set up here. I just wanted to give John a little intro before we begin the webinar. I've known John for a couple years now. He used to live in beautiful sunny Santa Barbara where I'm from, and you know, some of the ways that I started to get into DSP were, you know, from John's material. So, you know, this is going to be a very insightful little webinar. And with that, I'll hand it over to John. Again, the webinar is going to be kind of short and sweet. We're just going to cover a little bit of intro and then basic crash course on DSP. I have some questions that have been sent to me by people who cannot attend, so I'll try to answer those, and then we'll kind of give a little bit more information about the workshop we'll be hosting in October. So with that, take it away.
Thanks, Alex. I hope everyone can hear me. I'm John Ehlers. I'm an electrical engineer trained in fields and waves and information theory, and I've been a private trader since the mid-1970s. So what I want to do today is to give an introduction to digital signal processing, or DSP, for traders, and the emphasis is on for traders. So there is a real need and a use for this, and I want to share that with you today. So let's trying to get my page advance on my, there we go. Let's start with the simple moving average. In a simple moving average, I've got a thing on the screen, I've got it clear. The output is
John, we might have lost your voice. Can you check your audio real quick? There you go.
I pressed my mute button. I'm sorry. I'm going to start all over again. This first slide, we're going to be talking about a I'm clearing my screen. We got some warning messages here. I'm going to be talking about a 4-bar simple moving average to get started. The output is the sum of 4 inputs. It's the input plus for today, plus the input 1 bar ago, plus the input 2 bars ago, plus the input 3 bars ago. All 4 are divided by 4, so we have a summation of that equals unity. And it's just that simple. The written here, it's almost the way you have code in easy language. So if I, instead of writing it as in code, if I let the notation z to the -1 stand for 1 bar of delay, I can say that the input is equal to, or the output is equal to the input times the quantity 1 plus z to the -1 plus z to the -2 plus z to the -3, the whole quantity divided by 4. In other words, the output can be expressed as a polynomial times the input, or more precisely, if we divide the input on both sides of the equation, we have the transfer function, which is a straight polynomial. And that's the way to describe a moving average. Now, there's a couple things that we can see about a moving average. First of all, it's a polynomial, and it's one of a kind of a filter called a finite impulse response filter, because it uses a finite number of samples in creating the filter. The lag of the filter is about half its length, And is in this case of a simple moving average, all the coefficients of the filter are the same. But more generally, filters have coefficients that are evenly balanced about the center point, and for various smoothing functions, but they all are finite impulse response filters, and they all have about half, their lag is about half the length of the polynomial. But once you see that we have a polynomial, we could use different coefficients. They don't have to be balanced. And in fact, if you use artificial intelligence, you can fit the coefficients to existing data. And with AI, that's curve fitting on steroids, just by putting it to this polynomial coefficients. So one thing to watch out for if you're using AI software is the kind of model that you're using to describe. If it's a moving average model, there's a good danger of curve fitting. So there's another kind of moving average, the exponential moving average. So let's look at that in a general case. The output here is a fraction alpha times the input, and that fraction alpha can be a number between 0 and 1. And then the second term is the complement of that, 1 minus alpha, times the output 1 bar ago. Well, if I use the same z to the minus 1 notation and move all of the output terms to the left side of the equation, now the output times the quantity 1 minus the quantity 1 minus alpha times z to the minus 1 into quantity is equal to alpha times the input. Or in other words, the transfer function, the output divided by the input, is simply alpha divided by the quantity 1 minus alpha times z to the minus 1. In other words, in this case, the polynomial is in the denominator. And so we have a transfer function that has no polynomial in the numerator, but only 1 in the denominator. And this is called an infinite impulse response kind of filter, because in principle, it goes back in history to infinity. That is, today's calculation is dependent upon yesterday's calculation, and yesterday's calculation is dependent upon the calculation the day before, and so on. So it goes back to infinity. So we have two kinds of transfer responses as the sum of by just examining the simple moving average and exponential moving average. One has a polynomial in the numerator, and one has a polynomial in the denominator. And so if we look at the most general kind of transfer response, it looks something like this, with a second order polynomial in the numerator and second order polynomial in the denominator. So, and we can't get many more terms than this in practical usage for trading, because the longer the polynomial, the more the lag. And if you get too much lag, the party's over before you make your calculation. So the real trick is working with this transfer function to find the best coefficient for each application. And that's where the majority of the effort falls. But to do that, I like to think in terms of the frequency domain instead of the time domain. That is, traders most likely look at squiggly lines. They look at stochastics or RSIs, and that's kind of like the left-hand side of this moving curve you see. That's the squiggly line in the time domain. But you see on the right-hand side, there is a phasor that is rotating, and the phase of that arrow is a generator for the squiggly line. In other words, frequency is the rate change of phase, how fast that arrow is rotating. And so I prefer to think in terms of the frequency domain instead of the time domain. It makes analysis a whole lot simpler. And here's an example I want to show you that kind of hopefully drives that point home. The violet line at the bottom is a sine wave that I've arbitrarily drawn, and I've replicated that at the center as a black line. Now to that violet line, I'm going to introduce the cyan line, which is a half amplitude but twice the frequency. You see here is one cycle of the cyan line, and here is the other. And so that's twice the frequency and half the amplitude. And when I add the violet line and the cyan line together, I get this kind of lumpy sine wave of the green line in the center. Now I can continue this one more time and add a third harmonic. That is the brown line here, you see here is 1.5 cycle for that alternation, and then another 1.5 cycles. So that's a third harmonic at 1/3 the amplitude. And when I add these 3 cycle components together, I get this orange waveform in the center, which is very reminiscent and is descriptive of an Elliott wave. An Elliott wave consists of 3 thrusts and 2 reversals in a 5-wave function. So here are your steps in the wave. Wave 1, wave 2, wave 3, wave 4, and wave 5. Of course, Elliott waves are a lot more complicated than that. In the first place, they're fractal, and so you have Elliott waves on top of Elliott waves, and their interpretation becomes very, very difficult and very subjective. However, what I wanted to demonstrate is that the Elliott wave itself can be comprised of cycle primitives. And if you go back to the primitives, you can get the main motion of the market without being concerned with the details. And it certainly makes all analysis much, much easier. So this is the kind of thing that I'm going to be addressing in my workshop, October 20th to 22nd. It's going to be indeed a lot more thorough and a lot deeper. It's 3 full days of one-on-one experience, and it's only limiting attendance to 25 individuals, so it's going to be intimate and one-on-one learning experience where I'm going to roll in the last 40 years of my experience and research and come complete with code that has latest state-of-the-art indicators, as well as trading and complete trading strategies that can be automated for both daily bars and intraday bars. So I would hope that this little introduction to digital signal processing whets your appetite to come. And if you'd like to read more about it, you can go to my website, mesasoftware.com, with the # workshop, or just scroll down from the home page and you'll get to see more about it. You'll get to see the details, syllabus of the course, and all the details like that. So with that, Alex?
Yeah, we have some pre-questions that people have been sending in, some that couldn't attend. We actually hit our limit, so I apologize for people who tried to get in today. For some reason, they maxed us out at like 500 seats. So, I'll post this recording shortly after. But the first question is sort of a question that I put together. And, one of the things that we talked about last year's workshop is the spectrum. And without giving too much away, I wanted to see if you could explain what the spectrum is in terms of DSP, and why is it important to trading?
Okay, if one rings a bell, that's a pure tone. Or if you hit a key on a piano, that is a kind of a tone. There are several wires involved in the piano. But the piano consists of many keys, and you can either hit all the keys all at the same time or play them sequentially, and depending how you do that, it's melodious or it's noise. And in concert, the description of all of the cycles hitting all of the keys, not necessarily at the same time, but either sequentially or all at the same time, that describes the spectrum. It's a composite of a lot of different tones.
Great. So when you apply it to like prices, the spectrum will pick up cycles within the prices. Is that kind of how it works?
Sure. You can identify underlying main constituents. For example, if you look at stock prices or stock index prices and look at the spectrum of that kind of data, you'll note that there is a more or less pervasive 1-month cycle or 20-bar cycle. And I don't like to assign causality because there's many sources of cycles in the market that create market cycles. But pretty much every company through mid-management on up, they have to make their numbers by the month. And so to see the resultant that there is a monthly cycle is no great surprise.
That's great. Okay, so the next question is someone says, W.D. Gann, he used to use a pencil and paper to count the days or the weeks between highs and lows, and he would essentially manually come up with these cycle periods. And then he noted a lot of in his writings that these cycles that would be present would disappear. In your scientific opinion, why do you think this happens, and is there a solution for this application in trading?
Well, there's two reasons. First of all, the cycles can disappear. Cycles are ephemeral; they come and they go. Or there are other cases where two nearly harmonic cycles will cancel each other. You've heard of active noise canceling.
Right.
That can happen also. So the way Gann did it was extremely crude. We're
well, you only have pencil and paper, like you said.
Yeah, well, now we have the power of even the home computers are pretty powerful, and in being able to analyze and do advanced analysis in depth and reduce the signal to noise ratio, which is a crucial aspect. Market data is incredibly noisy, and that is a big factor in how the software is created to analyze market data, is to cut down on the noise.
Great. Another thing that I picked up in last year's workshop, I just wanted to get a little taste from you, is you talked about this concept of noise in the data, specifically to brown noise and pink noise. Without really giving away the secret sauce of this, is how do you know there's multiple kinds of noise, and why does that matter when you're using trading indicators?
Oh, there's no secret sauce at all. It's
okay.
Quite clear. And by the way, 3 people from last year's seminar have already signed up. So I'm happy to see that there's some value there, that people are coming back for more. But the answer, look at it this way. If you look at a chart of daily bars and you look at another chart consisting of weekly bars and you lay them one over the top of the other and examine them, do you have
TradeStation open? Can you maybe give us a really brief example?
I'm afraid I'd mess up the display, but I'm going to try.
Yeah, let's try it. No mistakes.
Okay. Trying to open up that workspace. Here we go. I'm going to open this workspace. Okay, this is SPY, and if you look at the top one, that's weekly data, and if you look at the bottom one, that's daily data. You know, as a first order approximation, they kind of look the same. But if you think about it, the horizontal scales are ratioed by 5 to 1. So if they look the same and the horizontal scales are different by 5 to 1, that means the vertical scales are different by 5 to 1. In other words, the longer cycles have 5 times higher swings or bigger swings. So that, just looking at the fractal nature of the market, that longer cycles necessarily have proportionally higher peak-to-peak swings. I've coined a phrase called spectral dilation, and in a nutshell, it says for every octave of change in period, the longer cycles are double in amplitude. So if you're measuring cycles, you have to take that statistical feature of the characteristics of the market data into account. In other words, you have to compensate for spectral dilation. So that's an example.
That's a good answer, yeah. The next question we have is most oscillators, this was somebody sent me in, he says, most oscillators and indicators are displayed in a continuous form. Have you ever experimented with DSP tools in a more discrete way?
Sure.
I think he means
sure. Well, what I do, again, market data is really, really noisy. And so as an example of a discrete application, what I will do is I'll do a correlation. I'll correlate a pure sine wave with market data. And then on intraday data, say 15-minute bars, I will then use that pure sine wave and running for the duration of the day. In other words, it's only that pure sine wave is used so that real noise is not included in my decision process. I've got a pure signal. So that's a way, a trick of using correlation of a sine wave to market data, then using the sine wave to make your noise-free buying and selling decisions.
Thanks. Next question, we have maybe like 5 more, and then I'll let you talk about the workshop again, and we might just close this up. But the next question was, when I talked to Jerry about last year's workshop, what I mentioned to Jerry, he didn't actually realize is, some of these really huge hedge funds like Renaissance Capital and, some HFT firms nowadays, they display on their website, publicly that they employ quite a few DSP, digital signal processing PhD engineers and cryptography scientists. What are your just general thoughts on this, and why don't you think DSP has been more publicly embraced in trading?
Well, first of all, they're pretty smart.
Yeah,
people
obviously
know what they're doing. But in general, there has been a thing about trading that people seem to think it's easy, or they walk into it without any preparation or a minimum amount of preparation, and thinks that an RSI is going to salvage the day. And you need to think about trading the same way you would approach your own career. I mean, you probably spent 4 years in college, and then who knows how many years as a neophyte before you became a journeyman. And it's that kind of process. Trading is not easy. It looks easy, and there are practitioners that kind of advertise that it's really easy, how to make $1 million like I did, and that kind of thing. But in fact, it's really, really difficult. Now, regarding the engineers in the workplace, there is a thing about engineers. I was one, and so I can say this. Engineers are, in a sense, idealists, and when it comes to trading, you also have to know about the art of trading. You have to have a healthy dose of pragmatism involved in your analysis. So you can't be over the top analytical. You got to be practical in the application.
Was there any like scientific lab process or something that you learned in your professional career that you think is a big advantage to a lot of your experimenting and testing in the trading endeavors you have?
No, I kind of fell into it. I was trained in information theory, and I came across a process called maximum entropy spectrum analysis, and it was used in exploration for oil. In seismic exploration, they certainly have a short amount of data to work with, and I saw at the time in the 1970s people were using Fourier transforms, and I knew that was dead wrong, and so I applied the maximum entropy spectrum analysis to the market data, and that's kind of how I got into it. And frankly, I kind of thought in the land of the blind, the one-eyed man is king, and I have subsequently been
like one example someone just asked in the chat is how, can you just give a brief example of how, you know, a traditional RSI is different than, say, something you've published about, you know, a smoothed RSI? I don't know if you could just give a quick example like that tangibly here.
And RSI is a pretty good indicator, by the way. It's just misapplied so often. And that's the thing that got me started, was what's the best length of data to use to create an RSI? And there is an answer to that. It's a little complex. If you use a really, really short RSI, it's going to go from 0 to 100 and back again on every other bar. And if you use a million point or 1,000 point RSI, it's going to be centered, and it's going to be non-functional. Somewhere between those two limits is the right answer, and the right answer is you got to use about a half cycle worth of data. So you got to know what the cycle is and have some intuition into how to
apply
take that length.
I mean, what I always find interesting, John, is, you know, still to this day they have all these new platforms that come out, trading platforms, and you get what I call the default club indicators, your RSI, your stochastic, your MACD. I mean, these are things that were invented in the 60s, I think, and they still haven't really evolved in any way. Why do you think this is? Why do you think there's this
They missed some key points about digital signal processing. For example, at the very high frequency, we're sampling at on daily bars at 1 bar per day, and in digital terms, the Nyquist frequency is a 2-bar cycle. Well, there's no elimination of a thing called aliasing in standard configurations. So one must use special filtering to get rid of the aliasing before you even think about applying an RSI. And so I've written about a thing called roofing filter, and a roofing filter cuts out all of the out-of-band noise that help you get a better picture of the real data in the market.
Did you always, were you always a system developer, or, you know, was there somewhere on the line that you were trading discretionarily and then migrated all the way over to system development?
Sure. When I first started, I started trading because I got a bonus, and I didn't want to be have real estate and be a landlord. So I invested in commodities and trading commodities, and I was chasing rainstorms through every cornfield in Iowa until I discovered, frankly, until I discovered Mesa, and was trying to solve this problem of how to pick the right length for the RSI. So I started that way, but quickly, because of my technical background, transitioned to technical and algorithmic trading.
All right, I'll give you one more technical question. I actually think this is quite interesting. Someone asks, are you familiar with the Weierstrass function, which assumes that there's an infinity number of sines and cosines within the market cycles? How are you able to extract the period, amplitude, and phase? I don't know if you can
Well,
give a
it's a triple
concrete answer
infinity
to
of things
that.
to solve, and
Okay.
and the first answer is you're not interested in infinity. You're only interested, for example, if I'm working on intraday data, I'm only working with 15-minute bars, and so there's only 27 bars during a day, and I don't want to trade more than, say, twice a day, so I'm looking for something like a one cycle during a day, or a 27-bar cycle. So I limit what I'm looking for. That's the first thing. You cut down your range. And the second thing is the whole purpose of DSP is to use all the number crunching capability of the computers to solve the problems, to solve those coefficients in the transfer response. That's exactly what DSP does for you.
Nice. Okay, and how about you just reiterate when the workshop is, talk a little bit about what we're going to cover, and then I'll post this recording shortly after, guys. If you have any more questions, throw them in here, but I think we're running out of time, so I'm only going to tell John if it's a really interesting one.
Okay, please sign up for the workshop. It's October 20th to 22nd in San Simeon, California. You have to drive in. We're not close to any airport, but it's going to be an intimate experience. The number of traders is limited to 25. And like I said, 3 from last year have already signed up for this year. So that speaks to its value. I'm introducing not only DSP techniques, but unique indicators and unique both daily strategies and intraday strategies that you can pick up and use directly when you get home. Not only that, but you have the ability to interact with other knowledgeable traders. There's going to be 25 of us, 26, I hope, in the room. And not only, I'm not the only one doing the talking. Last year, several of the participants made little presentations of their own, and it was quite beneficial, I thought. So you can go to my website, mesasoftware.com, either scroll down from the main page or with the tab of # workshop, and you can sign up using PayPal. So please think about coming, and I'm sure you'll be delighted with the experience.
All right, thanks, John. I have a couple more questions here, and then we'll just end it. I wanted to see if there was a couple good ones. Might have answered some of these already. One I had is, you sort of already answered this, but, with all the trading books and publishers out there, if you've read about technical analysis, there's really only you who publishes work that's considered in the DSP topic. Why do you think that is? I mean, why do you think that there's so many technical people out there, but they all seem to just stick with the default club stuff? I mean, obviously the high-end hedge funds figure it out, but it just seems silly that nobody else would investigate this.
It ultimately boils down to talent, I suppose. My talent is in engineering and not in marketing, and I just don't.
They don't teach engineering stuff in finance, you think, like the basics of DSP yet?
Yeah. It will come out when the benefit becomes obvious.
Right.
How it can be used effectively by everyone. once you understand it and put a little time and effort into working with it, then it will become second nature and your preferred approach to looking at the market.
So the last question, and then we'll end it here, guys, is what mathematical preliminary skills should you have before you consider attending the workshop? What did you say last year? Like a basic knowledge of easy language coding and high school trigonometry was required?
Well, not even coding. No, the emphasis on is for traders. I always include that in the title, and I never lose that perspective. Sure, there's math involved. I've shown you in this webinar a little math which involves algebra, but it doesn't get a whole lot more difficult than that. There's a little trigonometry involved because we talk about sines and cosines. But mathematics at the high school level, there is certainly a lot more math that goes into Z transforms and so on. But like learning any kind of thing in school, you had to learn a lot, and you only used like 1% of it when you grow up. You used a lot of mathematics, but you don't need much to balance your checkbook. And so that's the pragmatic approach that I try to take. I'd only use that amount of math that's required to solve the problem.
Got it. Well, thank you so much for doing this real quick little crash course. I will post this recording later, you guys. If you have any questions, why don't you bring your email up again, John? And some of the questions I know I totally brushed over, but if people have more questions.
Okay, there it is.
You can go to his website, and then do you want to give out your direct email, or your email's on the website actually? So
yeah, Ehlers at mesasoftware.com. EHLERS at mesasoftware.com is my email address. I'd be happy to answer any questions anybody might have.
All right, thanks, John. Thanks, guys. I'll post this soon. Appreciate it. Have a great
Thanks, Alec.
Yeah.
Bye-bye.